All right, so here we are in the second part of today's lesson, which is looking at some new accounting principles that we have to learn as a result of working with income statements. So the four that we're going to be looking at are the time period concept, the fiscal period, which is closely related to the time period concept. We're going to look at the revenue recognition principle and then the matching principle. So the time period concept is an accounting rule, basically, that requires that the accounting for a business has to take place over specific time periods known as fiscal periods. So typically, they're 1 year. Sometimes you're going to hear people refer to this idea of a fiscal quarter, which is basically a 3 month chunk of, like, in a particular 3 month chunk of that fiscal year. So if I were to say the first fiscal quarter, that would mean the first 3 months of the fiscal year. Don't worry about that fiscal year thing. We'll talk about that in a minute. Now, this might seem a little bit obvious in terms of talking about time periods, but um, part of it is to make sure that we're comparing apples to apples. So if we're looking at investing in two different businesses, for instance, we want to make sure that the data we're looking at is for the same length of time. It may not always be the exact same time period, but it's always the same length of time, and that's very important. A lot of these rules are to maintain some standardization, but some of the rules are to prevent like fraud or making things look kind of different than they are. And if people were allowed to kind of mess around with the amount of time that um, you're reporting on, it would make it look, or it could make it be very misleading. So now we're going to talk about this idea of a fiscal period. So we're quite used to this idea of a calendar year and going from January 1st to December 31st. Some businesses, quite a few businesses, use the calendar year as their fiscal year. So they would literally begin their record keeping on January 1st of the year and then close off their books at the end of the year. I should say December 31st. And they would show that, or they would show their revenue and their expenses and therefore their profit for the calendar year. Most businesses, though, for a variety of reasons, use a fiscal year that is not the same as a calendar year. And the way that would look is that it would start on the first day of whatever month, and they could choose a different day. I mean, they could choose in the middle of the month if they want to. But usually businesses pick the first day of a particular month and in the current calendar year, and the fiscal year would last until 1 year from there. So it would effectively be March 31st, but of the following year. So in this case, 2017. This is very common. Like I said, it's done for a variety of reasons. A lot of it has to do with the accounting process and preparing tax documents for the government. Some of these things can take a lot of time, and so depending when the tax reports are due at the government, the businesses will arrange their fiscal year to make it workable so that they can get their reports done for the government. Other reasons might involve, for investor reasons, sometimes it's because of the cycle of the year. If you're in agriculture, for instance, it might be a little bit different because it would be worked around your growing and harvest and selling seasons, for example. The next one we're going to look at is the revenue recognition principle. So in this case, we're going to continue on and with our company that has a fiscal year that goes from April 1st, 2016 to March 31st, 2017. Now, even though part of this fiscal year is occurring in 27, the majority of it is happening or occurring in fiscal 2016. So typically that's where that would be the name of the year. It would be fiscal 2016. This rule says that regardless of when a service is paid for, so when payment is actually made really has nothing to do with this. When the revenue is generated, so when the customer is billed or when the service is provided, that is the period in which the revenue has to be declared. And so we have cases where where especially at the end of the year, somebody will come into a business and they will buy a service and not pay for it until the next fiscal year. I mean, they don't really know that. We don't, explain this to customers or anything. It's just the way it happens. So for a couple of reasons, one is just for standardization. Whenever we have some revenue, we recognize it or declare it in the fiscal period in which it was actually sold, not when it was actually paid for. Again, this is just a standardization thing. The other reason is, again, for taxes. If a company had a really, really good year and was making a lot of money, they might be tempted to take those last few sales or all the sales that weren't paid for yet and put them into their next fiscal year, hoping maybe that they weren't going to make as much, and then they could make their current sales and profit look a little bit less, and therefore they would pay less taxes. Under the way the rules are set up now, that would be illegal. And so what's important is I can't sell a service during 2016 and then just to decide to turn around and claim that it was part of my sales in 2017, even if that was paid for, even if I thought I was doing the right thing, it would be wrong. The last one we're going to look at is this matching principle. And then when we talk about matching, we're talking about matching expenses and revenue, not just any expenses and revenue, but we are matching expenses with the revenue that those expenses generated, which sounds a little bit like gobbledygook, but I'm going to explain. So in this example, if I generate $50,000 from selling services in 2016, then we know from the previous principle that we have to declare it as part of our fiscal 2016. Well, all the expenses that I incurred to generate that $50,000 also have to be declared as part of that $50,000 or along with that $50,000. So the rent that I paid on my building while generating that revenue, as well as all the staff expenses, all the other utility expenses, all the office supplies, anything I used up during that fiscal year to generate that $50,000 also has to be declared as being part of that fiscal year. So I can't, again, monkey around with the numbers and kind of make things look different than they really are. Now, for most things, this is pretty straightforward, but there's some things so for instance, like a car. Let's suppose that I bought a car on January 31st, or January 1st rather, of 2017. So that would mean that I was using that car up for those last 3 months of the year. I was using that car up for the last 3 months. Well, a lot of us will understand depreciation and how we use up a car over time. Well, even though I might not sell that car for as part of the business for 5, 10 years, each year that I'm using it up, I have to declare part of the usage of that car towards those expenses. So even though I only own that car for 3 months, even though I might not sell it for another 10 years, the fact that I used it for 3 months to generate that $50,000 in revenue, I have to declare part of the value of that car towards the expenses in generating that $50,000. That's called depreciation, and we will be covering that later in the course. So those are the 4 principles then: the matching principle, the revenue recognition principle, and the time period, the fiscal concept, or the fiscal period concept. Very important, and again, part of how accountants conduct themselves, as well as usually being consistent with oftentimes financial reporting law.